Hello everyone. Our lesson for today is all about GAAP or generally accepted accounting principle. GAAP also refers to a common set of accounting principles, standards, and procedures issued by the Financial Accounting Standards Board or FASB. Public companies in the US must follow GAAP when their accountants compile their financial statements. GAAP is also a combination of authoritative standards set by the policy boards and the commonly accepted ways of recording and reporting accounting information. And it aims to improve the clarity, consistency, and comparability of the communication of financial information. GAAP may be contrasted with pro forma accounting, which is a non GAAP financial reporting method. Internationally, the equivalent to GAAP in the US is referred to as the International Financial Reporting Standards or IFRS. IFRS is currently used in 166 jurisdictions. GAAP helps govern the world of accounting according to general rules and guidelines. It attempts to standardize and regulate the definitions, assumptions, and methods used in accounting across all industries. GAAP covers such topics as revenue recognition, balance sheet classification, and materiality. And the ultimate goal of GAAP is to ensure a company's financial statements are complete, consistent, and comparable. This makes it easier to investors to analyze and extract useful information from the company's financial statements, including data over a period of time. It also facilitates the comparison of financial information across different companies. Now, there are 10 general concepts that lay out the main mission of GAAP, or it is also called as the 10 principles of GAAP. So, the first five are principle of regularity, consistency, sincerity, permanence of methods, and then non compensation. So, what are these first five principles? So the first one is principle of regularity. In this principle, the accountants has adhered to GAAP rules and regulations as a standard. Second is a principle of consistency. In this principle, accountants commit to applying the same standards throughout the reporting process from one period to the next to ensure financial comparability between periods. Accountants are expected to fully disclose and explain the reasons behind any change or updated standards in the footnotes to the financial statements. Number three, principle of sincerity. In this principle, the accountant strives to provide an accurate and impartial depiction of a company's financial situation. Fourth is principle of permanence of methods. In here, the procedures used in financial reporting should be consistent, allowing a comparison of the company's financial information. The fifth principle is of non compensation. Both negative and positive should be reported with full transparency and without the expectation of debt compensation. So, next five are the principle of prudence, continuity, periodicity, materiality, and utmost good faith. So, number six, principle of prudence. This refers to emphasizing fact based financial data or representation that is not clouded by speculation. Number seven is principle of continuity. While valuing assets, it should be assumed that the business will continue to operate. And then number eight, principle of periodicity. In here, entries should be distributed across the appropriate periods of time. For example, revenue should be reported in its relevant accounting period. Number nine is principle of materiality. Accountants must strive to fully disclose all financial data and accounting information in financial reports. Then number 10, principle of utmost good faith, derived from the Latin phrase "obere me fide," used within the insurance industry. It presupposes that parties remain honest in all transactions. Now let's go to the compliance with GAAP. If a corporation's stock is publicly traded, its financial statements must adhere to rules established by the U.S. Securities and Exchange Commission, or SEC. SEC requires that publicly traded companies in the U.S. regularly file GAAP or GAAP compliant financial statements in order to remain publicly listed on the stock exchange. GAAP compliance is ensured through an appropriate auditor's opinion, resulting from an external audit by a certified public accounting firm. Although it is not required for non publicly traded companies, GAAP is viewed favorably by lenders and creditors. Most financial institutions will require annual GAAP compliant financial statements as a part of their debt covenants when issuing business loans. As a result, most companies in the United States do follow GAAP. So this ends the first part of GAAP. So I will be uploading the next part about GAAP versus IFRS. So have a good day, everyone.